Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. I hear that introduction every week and still kind of amazes me. I'm thinking, hey, wait a minute. That's my company. So I'm back here. We've got Mike Seeger with me. Welcome back, Mike.
Hi. Thanks for having me back.
No problem. Mike is a student at Case Western, and is majoring in economics, I believe. And do you have a minor there?
No, I don't have a minor picked up.
Okay, cool. So major in economics, so we got a lot in common that way. And Mike is actually going to be helping with the Look Out for the Bull website that we are resurrecting. Actually, he will be doing most of it. I will be assisting, doing a lot of the content. And it's going to be a lot of fun. So you want to stay tuned. We'll have Mike on back periodically because Look Out for the Bull website. It's going to be a different website. It's very positive, I think. We're going to basically tell you how it is, what you're up against, which is kind of the way I like to do business. It's the way I like to be treated. If I'm going to go into something, tell me what I'm up against and be real. Don't mislead. Because I'm a big boy and I can take it. What I'm really not fond of is when people aren't upfront about things or they disclose things later on in the process after you've already signed up. So we want to try to avoid that if possible. And we got a seminar coming up here, and I had to do this one on a Saturday morning. I normally reserve those for the summer, but all the Thursday evenings were reserved. So what I'll be doing is October 27th, so just a few days right before Halloween, we're going to meet back at the Corporate College on the East Side, 8:30 in the morning, Saturday morning. It's going to be literally 1 hour. I know everybody that knows me is going, oh, yeah, right, it's only going to be an hour. But no, it's going to be an hour. So we're going to start at 8:30 sharp, and I'm going to talk for a half an hour. And the topic is going to be, we're coming into, by the way, I didn't edit this. I should have checked this before I approved it. Yeah, anyway, but it sounds really weird, but coming into what has been the best 6 weeks of the year for the past few years, and why? Because that's where we're coming. At that point in time, there will be a little bit over 6 weeks left. But actually, I think starting near the end of October, it's really more like a 6 to 8 week time period. But for the past few years, market's been doing very well. In fact, a large portion of its annual gains have been made during that time period. So I think this is a really good time to take a look at why that has played out that way and what we're trying to do in order to help ourselves best capture as much of that as we can. And now that I've actually said that and put that out there, it'll probably, the market will probably take a dump. But I don't know. I think there's some reasons for it, and I think those reasons are probably still in place. So we'll talk about that. That's going to be the topic of that particular seminar. It's going to be quick. It's going to be very quick. We're going to talk a little bit about the Look Out for the Bull website that is under construction and going to be released here relatively quickly. And again, Mike's going to be a big part of that. He's actually going to be the biggest part of that. I'm just going to provide research and some commentary, and he'll be doing the heavy lifting. So I don't know what you think about that, Mike. Hopefully,
I'm excited for that. That's what I'd have to say. I'm looking forward to it, and Bill is pretty great to work with.
Oh, that's awesome! And
he didn't pay me to say that.
Yeah. And I was gonna add that. So anyway, if you have a phone call, question, or comment, 216-901-0945, 216-901-0945. And Mike and I were meeting this morning. We're talking about different things. We talk about a lot of different stuff. I don't know that we talked about this in particular, but I think that the financial planning aspect of most people's lives, it's actually relatively simple. there are a lot of things that you just can't know answers to. And I think that's a big part of the whole financial planning process is figuring out what you can know. And try to figure out what you can know. A lot of things you just can't know the answers to. People come for help on a lot of that. And oftentimes it comes down to, well, you just have to do your best effort, give your best effort to come up with an estimate. That's what you've got to do. And you're telling me, I think it's really fascinating that you're taking econ courses. I haven't opened an economics book probably, I don't know, since a few years after I left college. So I'm sure they've changed a lot of the things that they're doing, but...
Well, I think, a lot of it that I'm going over right now is the pretty basics: demand, supply. How a market reacts to price changes, stuff like that. So I don't think they've changed much about the whole body of economics in the past, 20, 30 years. But
I'd be really interested to see what they're going to be doing as far as the data goes. Back when I was in school, a compact disc. Okay, was the size of a vinyl record album. Mm-hmm. have you ever seen an album?
Oh, yeah,
okay.
Yeah.
So that was a compact disc back then. And Kent, which was where I was going, actually had a deal with the Federal Reserve. They published data and provided it to Kent. So the people from Case and all the other local universities that wanted at Ohio State, their graduate students were always coming up to our library to access that.
Huh.
And because they didn't have the internet back then. So if you wanted to use that data, you had to come to us. And I don't know how they got selected for that. I thought it was awesome, but and I would use it occasionally. But today, that's the part that's really fascinating, because there's a big difference between correlation and causation. And I think you'll probably find that a lot of econ guys confuse the two. It's easy to do. Mm-hmm. That's really easy to do. Correlation means when this happens, this has happened X percentage of the time. Okay. Causation is if I push down on the left-hand side of a seesaw, the right-hand side is going up. Now, that could be very misleading, especially if you put a wall dividing the left-hand side and right-hand side, just giving enough a hole in the wall so that the joint can get through the wall, and you can make that happen. But if somebody got wise and cut off the left-hand side and put a small lever on there and then started moving it randomly, you might not be able to tell. And let's say you could only see the two seats. So you'd see the left-hand seat sitting there on the ground, and you'd see the right-hand seat going up and down. Because some smart aleck decided to try to trick everybody.
There's the example I've always heard to explain correlation is that if in the summertime ice cream sales go up,
right,
and so do sunburns, so does ice cream cause sunburn. It's right, that general idea.
Right. Yeah. I love it. Do they still use the guns and butter thing?
Yes,
oh,
yes,
man.
They do.
That one killed me.
World War II. Yep.
Yeah. Wow. Okay. I wasn't a really big fan of that one. There are a lot of things in econ that I didn't like a lot, but I'm really interested because now they've got so much more data. The data is better. The ability to handle and process data is a lot better. But it, as you mentioned a little bit earlier, the basics are not going to change. The ability to track the basics has changed a lot. We've improved on that quite a bit. And so I think that's, it's pretty exciting. There are a lot of hedge funds out there that run macro and microeconomic analysis and are actually using it to manage money. They've been doing that for a long time. Most of the time, it hasn't worked very well.
I wouldn't think so.
Yeah. But they are making strides in that area. So I think that's pretty cool. And that's where when you think about the basic logic behind investing, the basic logic really hasn't changed a lot. How you execute that logic has changed. So the basic logic is if a stock's sales and profits are rising, if the company's prospering, eventually its share price goes up. Well, that hasn't changed. The speed at which they go up has changed a little.
Astronomically.
Both directions.
Yes.
And actually the choppiness, how much a stock will fluctuate within a range has really has changed. A lot. So that portion has really changed. But there are still some basic things that you can do to help yourself deal with that. If you're an investor, you've got to deal with it. So how do you do that? That's what the Lookout for the Bull. That's why you're here. And we're going to have a methodology, or I said I wasn't going to use that word, but then I said
checklist.
Yes, we're going to have a checklist. You're going to use a checklist to help you, and it's all based on fundamental logic stuff that's really simple. And anybody can do this, but I'm not going to caution you. We're not going to promise to make people rich overnight. Don't want to do that. Investing can be hard. At some point in time, it will be. At other times, it seems easy. And you need to enjoy those times. Remember those times, because when you're going through the hard times, you can think back to those. Sooner or later that those conditions reappear. You don't know when, and I think that's a big part of the problem. And kind of like, the Browns were so bad for so long, and all of a sudden this quarterback comes in, starts looking pretty good. And by the way, the quarterback looks good because the receivers and offensive line are playing really well. So they're all looking good. Is that going to stay that way? You don't know. You hope. Looks like they might have things on track. And investing is very similar. It always amazed me how similar the stock market was to real life. You have a lot of things that are okay. It's okay. You get by. And then occasionally you'll have, wow, that was really good. And then occasionally you're really scared. And so I think that's one of the reasons that people will always need people like us as really coaches, to say, yeah, this is normal. This is absolutely normal. As if you're not like you are, you're starting to study much earlier. I majored in economics. I had 24 semester credit hours of finance. And it didn't really help that much because I didn't have any money. So I'm looking at this stuff, and basically I'm just sitting in the classes, and you're memorizing it because you have to pass the test. So there was really not much of a real-world application. And I think if you're going to learn something really well, a real-world application is a great way to do it. I've always said experience is a great teacher. And I used to say, especially if it's someone else's. If someone else can go and blaze the trail, and you can learn from that, that's a lot easier than you having to blaze a trail, because, the pioneers were the ones with the arrows in their backs. But in some cases, it's actually necessary to go through a lot of that. And I think with a website like that's what we're really going to try and do, is help people that are trying to make it through that. Even if all you do is gain an understanding of what it's like, of what the stock market's like, I think that's a big benefit, because you're going to be participating in it more than likely if you're an average U.S. citizen, to be able to reach your retirement goals. To be able to reach your goals at a 3.5% taxable interest rate that you could get on a senior bank loan fund right now, which is one of the safer, quote unquote safer. It still fluctuates, just not as much as other funds do. But if you're looking at treasuries, if you're looking at CDs, 5-year CDs now, I think I was looking at the rates a little over a week ago. It's about 3.5 if through Fidelity, if you go to the secondary market. Never mind if you don't know what that means. A 3.5% CD on $1 million gives you $35,000. Okay, on $1 million.
Right.
And that's taxable. Okay, so you're probably going to have somewhere around $28,000 a year. Very difficult to live on $28,000, and you got to have $1 million. So if you think about that, you're probably going to have to invest outside of CDs if you want to have more than $28,000 or so to live on when you retire. So it's not a optional thing. Back when interest rates, when I was in high school, interest rates on a money market were 18%. You could get a money market fund. It was buying short-term government treasuries and get 18%. That was unbelievable. That's only happened one time, by the way.
That's incredible.
It really is. People were buying houses. They were paying as much as 22% interest. 22%. Do you realize over a 3-year time period, when you're paying 22% interest, you've paid almost the entire cost of the house?
That's rough.
Yeah, that is super rough. And those days are gone. Interest rates are probably going to remain relatively low for a very long time because we are much more sophisticated, thanks to people that study economics, than we were in the past. And to raise interest rates to that level with the level of debt that the country has today, probably not going to happen. Probably not going to happen.
Probably.
Right. When you have 12 or 13 trillion dollars of interest-bearing debt and you start raising interest rates, when you go up 1%, okay, that's an extra 120 to 130 billion dollars that you are volunteering to pay out of the goodness of your heart because you're the one that gets to determine your own interest rate. The U.S. government determines its own interest rates, or the Fed does. And if they raise them by 1%, you're talking 120 to 130 billion dollars. Now, I used to say that's never going to happen. Now, I'm not so sure. I don't know that these guys are intelligent enough to avoid that. Yeah, we need to raise interest rates. Why? Well, because I need to make more money. Well, why do you need to make more money? Because I'm a billionaire. I can't get by on 1%. Okay. So if you raise interest rates 1%, okay. If we raise them to 3%, if we raise them by 3 full percentage points, now you're talking about 360. That will be the third largest item behind the military and Medicare. That'll be the third largest item, budget item for the U.S. federal budget, would be the interest on the debt. And I wouldn't put it completely out of question, but it doesn't make sense, especially if the government has control over that and they understand that this is going to cost them a lot of money. I hear music starting. I guess we got to take a commercial break. You're listening to Bill Bullington and Mike Seeger right here on 1420 The Answer. We'll be back after these messages. And we're back. You're listening to Bill Bullington and Michael Seeger here right on 1420 The Answer. By the way, this show is carried as a podcast on 955thefish.com. So if you miss it here and you want to pick it up there, you can always do that. Or you can go to bullingtoncapital.com and also listen to it there while you sign up for the upcoming seminar, which is the title. This is a long title. You know what? I think I may have scribbled this down, and I didn't expect them to put it in without editing it. But it says, coming into what has been the best 6 weeks of the year for the past few years and why. Okay, so we're coming up to the time of year over the past few years. This has been it. I mean, this has been where a huge percentage of the gains for the entire year has been made from now until the end of the year, which is a little bit more than that. Actually, yeah. What I'm going to say. September has typically been pretty rough, actually. It started off rough. August and September have been the two roughest months, and then they were followed by a big surge. So interesting. Should be a lot of fun. Should be a good time to be looking at a lot of the things that we're going to be doing. And this is where, when you're looking to make investments, you're going to be wanting to look at things like the look out for the bull list that we'll be publishing. We're actually going to be putting that up on a daily basis. It's really easy. It's easy to do that for us because it's just a list, and we'll show you how to set it up if you want to do it on your own. we'll put a little video together that shows them how to do that. But it'd be cheaper to get through us anyway. But if you wanted to play around with it and do other things, experiment yourself, then you'd want to subscribe to that other software and get ready to give up your other hobbies because you're going to be spending all your time doing this.
It is fun.
Yeah. So, but it is fun. And you can go to my website to sign up for that online. This is actually going to be a Saturday morning. It is going to be relatively short. I know I can hear all the people groaning that have heard that. I promise. We're not starting till 8:30. I have to be here in the studio by 10:45. So, and we're going from the west side to the east side. That's where I'll be traveling from. And anyway, so you can sign up for that online. It's October 27th. There's some pretty cool stuff. And we'll actually talk about a lot of this on an ongoing basis. I really don't mind giving away all the details. I cut a spot on the fish and I labeled it Vital Transparency. Okay, I feel like you need to know. I don't want this to be the Wizard of Oz. You look behind the curtain and you go, hey, wait a minute. That looks nothing like it. Okay, we don't want to do that. We want you to know. We want you to be as successful as you can possibly be in investing because it's not easy. Investing is not easy. So we're going to let you know everything. In fact, one of the things I did, I'm running a scan, and I've decided to just focus on one particular scan. In the past, I had 3, and I would combine them together. But I think the one has done a good enough job of capturing all the others that I'm going to just narrow it down to that one scan. And what that scan is going to show us are those companies that are currently performing in the top 10% of all stocks that are investable by funds. So top 10% of all investable stocks. Now, there's some other criteria that those stocks have got to meet in order to get that list. If you want to make money in a stock right away, you want to pick a stock that's going up, not a stock that's going down, which is the total opposite of the value investors. The value investing model that I am most fond of is 180 degrees of this. And people ask me all the time, well, how could you do both? Well, I don't know. Multiple personalities.
It's a balance.
Yeah, it is. Yin and the yang. I think it might be yin and yang.
It's yin.
Yeah. So, I had a friend in high school. His name was Ying. I always got that messed up too. But anyway, so to not really drag this out for the rest of the entire show, Under Armour comes up. Now, I like a company, by the way, who has good underlying fundamentals, things like sales, profits, has a history of having sales and profits. I think that's a really good idea that you have a history of having sales and profits. Now, it's not that I won't invest in a company that's never had a profit, because I've made a lot of money in companies before they became completely profitable, but they were generating income. They had revenue. It's just that they were spending so much money that by the time they were able to deduct that, because they got to write a lot of that off, okay, it took all the profits and turned them into zero, okay, or turned them slightly negative, which is okay because they had enough money in their coffers to do that for a while.
Right, their sales were high enough. Right?
Yes, and they were growing fast enough, and the income from their operations was high enough that I went ahead and bought it anyway. Now, you wouldn't have to know any of that, by the way, and this is what really kills me all these years later. If you didn't know any of that, but you just followed the rules, you just followed the rules that told you when to buy, actually tell you what to buy, when to buy it, when to sell it, and the most important thing is how much. That's actually the most important thing. And every time I say that to a novice or a rookie, they go, why is that so important? And stick around, you'll find out. Just take it for granted. I said it's important. It's going to be important. We'll go over it at the seminar, why that's so important. But the amount that you put into the stock is actually the most crucial part of that whole formula. And everybody thinks it's getting the right stock at the right time. Wrong. Yeah, you won't know that. You don't know that. What you do know is that these stocks are moving right now, probably for a reason. Okay. They're moving right now. They come from a universe of stocks that you're selecting from that the mutual funds are investing in. Institutions you know are investing in these stocks. Okay. So if the institutions know something you don't, by the time you know it, it's going to be too late. So if you would take that part off of the formula, which I've done, I didn't put any, doesn't have to have a certain amount of sales growth, doesn't have to have a certain amount of profit that it's generating. We're only looking at size and price. We're also looking at price movement and the volume of shares that traded on the day that it made the scan. That's it. That's the criteria. So once we get that list, now me being a creature of habit, I go back and I look at what they actually do. Mm-hmm. And I look at whether or not they've been profitable. I look at their average profit margins. I'll typically look at profit margins of companies that are in the same industry. And right now, one of the companies I like a lot is Under Armour. Well, why do I like that a lot? Because they've made a lot of money over their lifetime. A lot of money. In fact, the revenue over the past 12 months was over $5 billion. That's pretty big.
Pretty big. A
lot of T-shirts. The market cap, on the other hand, that's what the stock is selling for, is $8.6 billion. That's only about 1.7 times their annual revenues. They took a charge against earnings. They're restructuring the company right now because their net income was a minus $159 million. That $159 million is not that much as a percentage of $5.3 billion. Okay, so that's not a big deal. Gross profit margin was actually almost 45%, which is very good. That's extremely good. What that tells me is if the gross profit margin was 45%, but they had losses, that means they're taking a write-off somewhere. They're shutting something down. They're taking a write-off, and I don't know what it is yet. I don't really care. Mainly, I don't care because if the stock goes down 15% from my purchase price, I'm out. So I don't really, for me.
The risk is managed.
Exactly. Yeah, I'm glad you put it in those terms too. We're managing the risk. We're doing the responsible thing. We're managing the risk. And that's essentially when you're managing portfolios, that's what you're really doing. Whether you're using this strategy, whether you're using my favorite value strategy, which is the total opposite of this, by the way, you're managing risk. That's what you're really trying to do. Manage the risk in your portfolio, trying to match up the right risk with your personality. That's a key. And there's a reason that I don't have more than 10% of my assets in this particular type of strategy, because I don't have the kind of time it takes to do that. And this has higher risk than the other things that I'm doing. So in order to manage that risk so that I can sleep at night, I just allocate a certain dollar amount to this. Now, I know people who do this with 100% of their money. I would not recommend that personally, unless you've got a lot of time, or maybe if you're in your 30s, yeah, no sweat, because you've got enough time to make that up if it goes badly, starts to go poorly. And you can probably take a bigger hit because you have that extra time. Mm-hmm. So I would say you're fine. You can do whatever you want. But if you're in your 50s or your 60s, you probably don't want to be doing this with all of your money. And most of the time when people take a look at it, it is fun. It's absolutely fun. I like thinking about Under Armour. So I'm going to go compare Under Armour to its probably biggest rival, and that's Nike. Okay, Nike had $37 billion in revenue, more than 5 or 6. Okay, that's huge. Nike sells for $135 billion, which is 3.7 times greater than its sales. What did I say Under Armour was? 1.6?
1.6.
Yeah, so about 1.6. Nike's selling at 3.7. Is Nike really 3 times better? Yeah, it's not actually 3 times, but say 2.5 times. I'm rounding off here. Are they really that much? I don't know. I don't I have Adidas on right now. But I really like the Under Armour stuff. Is Nike really that much? By the way, the gross profit margin for Nike is slightly lower than the gross profit margin on Under Armour. If you were responsible for making your company grow, would you rather have to grow $37 billion in sales or $5 or $6 billion in sales? Probably the 5 or 6.
Probably 5 or 6.
So these are all the thoughts that go through my mind. By the way, that went through my mind when I was thinking about it in about 20 seconds because I've been doing this for 30 years. Actually, I didn't learn this until, I was almost 10 years in the business. Back then, there were so many taboos over people that would do stuff like this. It was mind-boggling. I mean, they really discouraged me from trying to do this. They kept me from doing it for a long time. But I started seeing people like Richard Dryhouse, who had a phenomenal track record. I was reading Peter Lynch, phenomenal track record. Those guys were using stuff like this, and I'm going, hey, wait a minute. Unless you guys can put a track record together that's like theirs, then maybe I should start doing some of these things. And it's fun. It's actually very fun. And I think you'll probably, when you get further into it, you'll probably get a kick out of it. And I just don't trade enough or invest enough in this particular type of portfolio to risk my livelihood. If I lost all the money in this, which the chances of me doing that are not as good, the chances are not as good as the Browns going undefeated the rest of the season. Because of the way that I'm doing it. It would be incredibly difficult. And that's what you got to do. You have to learn how to make this really hard not to lose a lot of money. And that's all risk control. You're controlling the risk. You're doing the right things. You're stepping up to the plate and saying, hey, I'm going to push my ego aside. Sometimes that's hard to do for a lot of people. And if you have problems with ego, then I think you should learn this because it'll help you get that under control.
It, yeah.
It's kind of funny. But so anyway, that's what went through my mind when I saw Under Armour. I'm going, hey, I see a lot of potential there. Incidentally, if you look at Under Armour's highest ever price, which wasn't even that long ago, and so that's amazing how things can change so quickly. Back in 2015, actually, September 30th. That's amazing that came up at that time. 2015 was its peak at $52. It's at $21 today. It was at $52 3 years ago.
Wow.
It's at $21 today. So I'm going, it's already been there. Anyway, that would just be one of the examples of a company that would come up on our scans. And when we get this going, since I've got you there, I'm going to shoot you a text. You can post it. Put it up on the website. It won't be complicated. It'll be a fraction of the time that I just took to explain to explain that. It'll be something like Under Armour looks good. There's another one that I really like a lot. It's a company called Future Fuel, and the symbol is FF. And just go to their website. It's got a price to sales ratio of 2.6, which is kind of it's not super low. It's right around average for the S&P 500 right now. Maybe slightly above that. But the revenue, oh man, we're going to have to wait until after the commercial break. Hey, you're listening to Mike Seeger and Bill Bullington right here on 1420 The Answer. Stay tuned because we'll be right back.
We were made to be courageous. We were made to be courageous. We were warriors on the front lines. Standing.
And we're back. Hey, listen, if you have a phone call, question, or comment, you can always reach us, 216-901-0945. Go to my website, bullingtoncapital.com. People ask me a lot of times, what do you do? I would say our specialty is really retirement income planning. That's what we do. We try to structure portfolios to help you keep up with inflation during retirement. That's really hard to do. We're going to try to keep up with inflation so that you can avoid running out of money if you live into your 90s. That's basically what we're kind of focused on. And a large part of that is investing. It would be great, if you could go back and get those 18% interest rates from a money market account. Probably is not happening anytime real soon. And realistically, you're probably going to have a fairly significant portion of your assets invested in stocks in some way, shape, or form. Now, the stuff that we've been talking about on today's program is really just for a small portion of your assets. It's the portion that I find is the most fun because I really like it. But most of your money should be in stuff that's clearly defined. We've got several dividend models that we use, several different ETF models. Got the Bullington Capital Value Model. We'll talk a little bit about that on that seminar that's coming up. And again, I forgot where it was. It's a Saturday morning. October 27th, 8:30. It's only going to go for an hour. Literally, we're going to go for an hour. I'm only going to talk for 30 minutes. That means I have 3 topics. I have 10 minutes each topic, and then I'm going to open up for questions. And I have to scoot because I got to come back to the radio station and do this show. So it should be a lot of fun. There's no cost to attend. Seating is limited, and we'll have a continental breakfast out there. It should be a good time. So feel free to sign up for that online. But kind of back to what I was talking about, we're going to take a look at what you need to do as an individual to try to keep up with inflation and be able to take income out of your investments during retirement. And I really feel like the retirement should be the primary goal that most people have in their lives. That should be the primary financial goal. The reason I focus on that is it's very important. Oftentimes people come in and they want to know, how to fund their kids' college. And when you look at the cost of college, that's a major feat. To save adequately for your retirement and your kids' college is a major task. We can try to help you with that. I'm going to tell you that those are major tasks. You start having a bunch of girls like I did and start paying for weddings, you're going, wow, I might just keep working. And I probably will. Yeah, but anyway, so that's kind of the focus because I feel like it's so important. And anyway, you can call us 216-901-0945. I see somebody has called in. Don't know who they are yet. Still getting the name there, but you can always reach me in the office too. So here we go. Larry, you're on the Bullington Capital Report.
Morning, Bill. How you doing? Hello, Mike. How you doing, too?
Good. How are you?
Oh, it's good. All right, fine. Good to hear you again, by the way. You going to be getting bumped by the football again regularly here now?
I don't think we're getting bumped again this year. We get bumped typically once a year.
All right. Missed you, Okay, I was just looking at that future fuel here at $19, and let's see, where's it? Back in March of 14, it was up at $22. These little bottle rockets take my breath away.
Yeah.
I get nervous.
Yeah, that's when you need a checklist.
Uh-huh.
If you got the checklist, you're not nervous anymore.
All right. Okay. All right. Well,
yep.
If you say so. I was just wondering, some of those old favorites. Are you still keeping the faith on J.C. Penney? They lost the CFO this past week or whatever. Do you think there's anything there, or is that just a dead horse?
I don't know. I really hope that they can turn things around there. I did increase my position in the last 2 weeks. I increased it by a lot. But if you know me, you know that I don't put enough money into any one stock that's ever going to really, even if it went to zero, if they go into bankruptcy, it's not going to have an impact on my lifestyle. So, but I did. I bought 3 times as much stock, by the way, because it brought my cost basis down enormously. So we'll see.
Okay. And what about that other champion, Rite Aid? Is it stupid cheap again? Is there any value there?
Well, it might be valued. Now, that was one of the ones that came up on the scans for the Look Out for the Bull website when I was doing that the last time. and I put a trailing stop on there and did extremely well.
I see.
But
Right.
if I look at it from a revenue standpoint, the revenues were down big time. I don't know if that's because they sold off some divisions or shut them down.
Okay.
When they do that, they're generally taking charges against earnings, so they're going to experience losses. The gross profit margin is still around 21%, which is not bad for that industry. But the market cap or the market value of the stock is $1.3 billion versus $21 billion in revenue. So it's really, really cheap. It's actually just slightly above where I had purchased that stock when I talked about it. It was right around $1 when I bought it. And I got stopped out somewhere around $5 or $6 on it, if I think I can think clearly. But
Right. Okay, how about one more of that old favorite, rail? You still there?
yeah, I still have that one. And
Okay.
I don't know what's going to happen there, but the valuation on it, it's still really cheap. I keep thinking at some point in time, maybe, who knows?
Right.
But you never know.
Speaking, I was looking at another old favorite there, good old Big Five Sporting Goods or whatever. Tell you what, I like it a lot more at $5 than at $9.
Yeah, well, that came up on a momentum scan, and you bring up a really important point here. A lot of people buy this stuff and just hold on to it. That's not a good idea.
Right.
When you hear me say that comes up on a scan, I'm using a trailing stop on there. Okay, so I won't be in those stocks. I do not buy and hold stuff unless I'm telling you this is a long-term investment. This did not come up on my momentum screens. Those are two entirely different strategies.
Okay.
And people confuse that a lot, by the way. You can get in real big trouble doing that. And that is not a good...
Right. Okay. Looking forward to the new website if it comes up. Are you still considering names? How about Taurus Tales? Taurus Tales.
Yeah, that sounds...
Spell that either Tails or Tales, however you like.
Yeah.
I like that.
If you don't like it, pitch it, forget it.
No, sounds good.
It was just a thought,
Yeah. All right. Well, I appreciate it, Larry. Thanks for calling. Thanks for being a listener, too.
Thanks
really
a lot.
Appreciate
Take
it.
care.
Yep. Bye-bye.
Bye-bye.
Yeah, that's one of the things, Mike, that you're going to find out. You have to repeat things a lot because people are listening on the radio. They're typically not taking notes.
Right. Yeah.
And when we talk about a various style or strategy, the vast majority of people who are above the age of 50, I'm included in that group, by the way. When you're above the age of 50, they have a tendency to want you to be one thing. And they don't really, I don't know what's happening there. I think as the older you get, the harder it is to open up. And oftentimes your mind starts to shut down a little bit. And I always feared that when I was younger because I was seeing it happen in a lot of the clients that I had. And I still see it, and I just accept it as a part of aging. So it can be pretty tough. You have to try to be really clear and saying, hey, this is one of the stocks where you would actually use a trailing stop on it. Here's another stock that I probably wouldn't do that. If this stock actually dropped, I would end up probably adding to my position. Discover Financial Services like that, Rails like that. I've picked up a bunch of Rail. That stock's been as high as 17 since I've owned it. It's been as low as 9 since I've owned it. I think my average cost base is somewhere around 12 or 13 bucks. I don't care. I don't even know where it is now. Oh, it's at 16.
Well, I'll say to that, that's also very true about people my age because one of the most glaring flaws in people that are 20s, 30s, they're very impatient. So if you're going to tell them here's 2 different strategies or here's how you would do 3 different ways to work with your money, then give me one. Give me the best one. Do it. Go. I got things to do. So I think that's probably just more of a human flaw than a
that's
particular
good to know. That's good to know. Yeah. So we'll just chalk that up to the human flawed category. There are lots of those. So no, it is hard. It took me a long time. I started off by looking at things like sales, profit margins, what's the book value, ratio analysis, trying to estimate what you thought a company was actually worth. That's good. That's fine. Very difficult. It requires an extreme amount of patience. So, which is why I learned the trend following approach. And you can actually put those together when a company, that's what I would consider Under Armour, at a price to sales ratio the way it is now, I know I am not the only person on the planet. I mean, I know people that acquire businesses professionally, private equity firms. They go out and buy a business. I know they will not get that for that price. So if they come into the market and try to buy that company, they're going to pay a lot more than it's currently selling for. At least that's my opinion. And we always have to state that that's our opinion when we state something like that, because it's not a fact. That's just how I feel about it, having watched this over the years. When you look at a stock like Nike, how high it's been, and Nike, somebody was laughing about it because I guess it's share price. I haven't watched Nike in a really long time because Nike hasn't been cheap in a really long time. Hey, the music is here. That means our show is over. Anyway, thanks a lot for coming again, Mike.
Oh, yeah, no problem.
Appreciate you having here. That's Mike Seeger. He's going to be running the Look Out for the Bull website. I'm Bill Bullington here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.